Who's here? Eddie Ghabour is back. All right, Eddie, you've been a bear. I know you called it right in the beginning, but if you'd sat on the sidelines, as you did last quarter, you missed a 16% run-up in the NASDAQ. Are you still holding off from the market, not getting in?
Stuart, we think these next few months are going to be the most painful part of this 15-month bear market, and this is why we are going to continue to wait, and here's why. Number one, this banking crisis, in our opinion, is not over yet, and to think otherwise is naive. Secondly, we've got billions of dollars of commercial debt that has to get refinanced this year. Third is earnings. I think earnings season that's going to start next week with the banks are going to be very disappointing, as well as for tech. And then we've got a recession that will get confirmed this quarter, in our opinion. And lastly, and I think the most important out of all five of these things, is we have this looming debt ceiling debate that not a lot of people are talking about because our focus has been moved to other areas. If we don't have a debt ceiling agreement by June, our debt's probably going to get downgraded, and that's going to cause a tremendous amount of volatility like it did in 11. And I think we will have new lows if all of these things happen. So as a fiduciary, I can't look at these things and say it's a buy right now.
What is a new low for you? At the moment, the S&P is at 4,100. What's the low that we're going to? 3,002, 3,004? Where are we going?
I believe that this S&P will bottom somewhere between 3,000 and 3,200. I don't believe this market is respecting the signal the bond market has been saying. We have too much debt, and we have an economy. This economic data is deteriorating week after week after week, and this market has not priced a recession, hasn't priced a problem with the capital markets of refinancing debt. These regional banks account for about 70% of business loans. They're not loaning any money right now, relatively speaking. So liquidity is drying up. And the last phase of the bear market is always the most painful, and it's when people least expect it. And right now, there's a lot of complacency.
I'm trying to do the math here. The S&P is at 4,100. You're saying it's going down about 1,000 points. That's roughly 25%. That would be almost a crash.
That's exactly right. And it's no different than any other bear market. These bounces we've seen are very typical. 08, 09, 2000, 2002, and on the way down to losing half of its value from peak to trough. So yeah, we may have missed one quarter, but we're a long-term investor, and our 15-month return is very, very good, relatively speaking, to those that continue to wait it out and not play defense.
As a money manager, it's dangerous, isn't it, to try to time the market?
Well, there's a difference between timing the market and timing an economic cycle, and that's what we have done. So we would have been in trouble if we waited till June of last year to start lowering risk, but we started in December of 2001 because we said the economic cycle was heading down. And we have yet to see the bottom of the economic activity. We're just now starting to see unemployment rise. We're starting to see weakness on the consumer. The JOLTS data was weak. This is not the end of the cycle. This is the very beginning part of where you get that recessionary data, and it can happen very fast. And that's what we think is going to happen in the coming months.
Ouch. Eddie, you make a lot of sense, but I hope you're wrong. Eddie Ghabour, thank you very much for being with us. I know we'll see you again. Thanks a lot, Eddie.
Thank you.